Okay, we are back. I'm very happy to have on the Goldstein on Gelt show Jean Chatzky, who is the financial editor for NBC's Today's Show. She is also the author of a fabulous book called Operation Money, a free financial guide for military service members and families, which was a huge gift that Jean has actually given to people in the military who unfortunately often don't get the greatest advice out there, and her book is packed with good advice. Jean, a real pleasure to have you.
Thank you so much. Thanks for having me on.
Let's talk about one of the biggest mistakes that, frankly, I've seen people make in terms of their retirement planning, which is in Social Security. There's so many options, and I think people get very overwhelmed with the options, and all too often they'll say, a bird in the hand is worth two in the bush, and as soon as they can, they sign up for it. But that seems to be something against the advice I've heard from you. Could you tell us why?
So actually 3/4 of Americans make that mistake. And the mistake is that they tap Social Security too early. What you have to understand, and these are averages, and you were so right when you said there are a lot of different ways to take Social Security. The people with the computers that actually run these things say there are 7,000 different scenarios. So there are a bunch. But I can give you some guidelines that will lead you in the right direction. And in general, later is better. For every year that you wait from age 62 until age 70 to tap Social Security, and this is for singles. I'll talk about couples in a second. But for every year you wait, you get an increase in your monthly benefits of about 8%, and that's guaranteed. It's a guaranteed return that is very, very difficult to replicate anywhere else these days. Mm-hmm. So waiting is better, and it can put, for single people, an additional $180,000 in your pocket over time. Now, the trick is that you have to live till age 80 in order for the math to work out in your favor, because essentially you are trading fewer, bigger payments for more, smaller payments. But you live past 80 and you've got it made. The math actually does work out in your favor, and we got some new longevity statistics just this week. Longevity rates have gone up yet again, life expectancies. And
that's terrible. Financial plans, of course. It's good for other reasons, but a real problem.
Exactly.
So you hit 62, just to clarify, someone on his 62nd birthday, if he doesn't need the cash from Social Security and he feels he's going to live past 80, then the odds are stacked in his favor if he waits till he's older, till he starts taking?
Yeah, exactly. And if you have two earners in the family, if you're or a non-earner and an earner, the higher earner needs to wait, but the person who's not as high an earner can actually tap earlier if you need the cash. And there are many scenarios where it even makes sense to draw money out of your retirement accounts rather than taking Social Security earlier than you have to because of that 8% guaranteed return. If you're not getting an 8% guaranteed return on your money in your retirement accounts, then waiting on Social Security is the better call. It's also one reason why I like people to think about tax diversification as far as their retirement accounts are concerned. Having some money in a Roth IRA where you don't have to pay taxes on that money is a nice pool of money to be able to tap in those early years of retirement.
Mm-hmm. One of the things I just want to note to our listeners, because a lot of people listening to the Goldstein on Gelt show live outside the United States and in Israel, in fact, and receive a non-U.S. pension. And as a result of that, they are hit by a qualification of Social Security called the Windfall Elimination provision, where basically it even happens in the United States if you get certain types of pensions there. But it's important to realize that if you're going to get a pension from a foreign government, your Social Security benefits might be cut. So these calculations have to be really carefully examined and don't just take a rule of thumb too quickly.
Absolutely. Absolutely. And there are companies out there that can help you run these various scenarios. So my source that I go to for numbers on this is a company called Social Security Solutions. They have a website, and they're very helpful.
Okay, we'll put a link to that at the show notes of today's show at goldsteinongelt.com. We're talking to Jean Chatzky, who is the financial editor for NBC's Today Show. She's also a best-selling author. She is AARP's personal finance ambassador. Now, AARP is a very important organization in that it helps so many people who are Americans who are retired answer many, many questions, including a lot of financial questions. Let's turn the questioning to a slightly different area, because today's markets have just been so crazy. People felt maybe comfortable. The market was looking like it was doing better over time, but all of a sudden it started to shake again. And now people are saying, I'm retiring. What should I do given the volatility of the market, even though everyone seems to say, well, long term, you should be in the stock market?
Well, the first thing to realize is that retirement is a long term. And even if you're retiring today, you still have to behave as if you have a long-term time horizon. What you don't want to have to do is sell into a down market. And it makes sense as you're transitioning into retirement to have at least 3 years, and some people will recommend 5 years worth of living expenses outside the market. They can still be in a retirement account, but outside the stock market, so that you're not exposed to that sort of volatility. Mm-hmm. You also, I'm sure that you have talked to your listeners about what the financial industry has called for many years the 4% rule, which basically says that if you withdraw no more than 4% of your retirement assets from your retirement accounts every single year, it will typically last you 30 years. What we learned in 2008, 2009, as the markets fell and a lot of people heading into retirement were really shattered, or their portfolios were really shattered, was that the rule failed a lot of people. And so particularly in times of volatility, downplaying those withdrawals in the early years makes a lot of sense.
Mm-hmm. So I like your concept of keeping 3 to 5 years of cash or short-term money available. Let's run some numbers here. Let's say that a couple lives on $70,000 a year, and they want to make sure that for the first 5 years in their retirement, or the next 5 years in their retirement, they can feel pretty confident. We're talking about keeping $350,000 out of the market. What should they put?
No, we're not. No, okay. We're not.
Let's clarify.
We're talking about, first you have to look at your pensions, right? And Social Security is a pension. And 17% of Americans, and I don't know the statistics for people who live in Israel, but I expect they're part of this pool in some way, have some other sort of pension income or some other sort of annuity. So you look at what that pool of money will cover, and then you subtract. So it's not like you have to keep the full $70,000 in cash, for example. Okay. You figure out what the gap is. It's sort of like planning for Medicare.
Okay, so let's dive into this a little more, because I think this is something I find people really worry about. Let's say the gap is $40,000 a year between your pensions and what you actually spend, and you want to keep, let's say, 5 years secure. So we're talking about $200,000. People obviously are a little unhappy with what they get in the banks. What's a reasonable short-term investment that would work today, given the low interest rate environment?
The low interest rate environment is a big, big problem for people who are transitioning into retirement. I think for right now, you want to keep it really short so that when interest rates do rise, you can start to take advantage of that. It's not worth taking additional risk. You can look at bonds. You can look at, you can look at different sorts of fixed income investments, but you've got to go out a good number of years in order to get any sort of substantial yield. Mm-hmm. So keep your options open and just, hope that for your sake, at least for the sake of your fixed income portfolio, the Fed decides that it's going to act.
Gene, I think that is a critical point. And one of the things that people don't necessarily realize is that there are many costs of managing money. And one of the costs is, if you want all of the benefits of liquidity and safety, the cost today is you just won't earn a lot on that money. But the benefits of having liquidity and safety can be huge, especially to someone who is retired. And so it's important to realize maybe you're almost paying for the service of having safety and liquidity by keeping the money in a short-term safe investment. But that's the cost of doing business sometimes.
Yeah, and the rest of your investments, the rest of your portfolio should be invested with growth in mind. Not 100% of it. You have to take a look at what you believe your asset allocation should be. But if we're going to live into our 80s and into our 90s, when we retire at 65, we've got a lot of years left, and that is a long-term time horizon.
All right, so let's finish on our interest rate discussion by looking at the opposite side, which is one of the benefits of a low interest rate environment is you can borrow money for cheap. For example,
Absolutely.
You can refinance your house when you're 55 or 60, take out a 25 or 30-year fixed rate mortgage at a pretty good rate. Why is it that may not be a good idea?
So I have to tell you, I was at the Fortune Most Powerful Women Summit about a week and a half ago. Actually, a little more than that now. I'm losing track of my days. But Warren Buffett was one of the speakers, and he said from the stage that the 30-year mortgage is basically a no-brainer. And I interpreted that to mean, a no-brainer at any age. And I get why he's saying that. Rates are extremely low. We still have a mortgage deduction. We don't have a deduction for basically any other kind of debt except for student loan debt. It's very, very cheap money. That said, I like the idea of heading into retirement when your income is likely to drop with fixed expenses that are minimized. I like the idea of not having a mortgage. And I understand that for many people, the math doesn't work to pay off the mortgage, and they would get a better return by borrowing the money, investing the money, and reaping the benefits from the markets. I totally get that. I am a little shy, regardless of debt in retirement.
Mm-hmm. Yeah, I think that's a great point, that there's a lot more to money than just running the numbers. There's the whole psychology of it, and realizing that when you feel a little bit more vulnerable because you no longer have an income stream from work that you might even be able to influence by working harder, if you're retired, you really want to feel as safe as possible. And having the weight of a debt, even a good deal on a mortgage, could definitely be psychologically, if not ultimately financially devastating if you use that borrowed money, invest in something else, and the investment turns south. Exactly.
And as we learned in 2008 and 2009, that can happen. We also learned in 2000, when the housing market, cratered in this country, that your house is not a sure bet either.
Yeah. All right. Jean, we've covered a lot of really, really critical information, especially for people in their retirement years or looking forward to it. But unfortunately, we're just about out of time. We've been talking to Jean Chatzky, who's the financial editor for NBC's Today Show. In the last few seconds, tell us, how can people learn more about you and follow the work that you're doing?
Oh, thanks so much. My website is jeanchatzky.com. There's a Z in my name, which makes it complicated. It's JeanChatzky.com. And if you're there, you'll see the ability to download the new Operation Money book, which is written for military families, but it's free for everyone.
Okay, great. And we will put a link to that at the show notes of GoldsteinOnGelt.com. Jean, thanks so much for your time.
Oh, my pleasure.
You've been listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Doug's weekly radio show is heard around the world, but if you miss it, you can download the podcast at www.goldsteinongelt.com. The Goldstein on Gelt Show gives you up-to-date financial ideas so you can get on the path to financial freedom. If you'd like your questions answered on the air or off, send Doug an email to doug@profile-financial.com. It's your money for your future, so join Doug every week to build your wealth on the Goldstein on Gelt Show.